But hey, we're going to talk about some software kind of acronyms, some jumbled up kind of finance alphabet soup, if you like, where we tend to just throw these things around and then expect that people that aren't in finance can understand them. Even things like SaaS. We say SaaS. What does that mean? We have most of us have a pretty basic handle on investing. I remember when I was starting out learning about finance. This was way back in the day, in my teens. I didn't know the difference between earnings and profit, and that is such an innocuous thing. They're actually the same thing. It's just depending on what you want to, however you want to call it, and however you want to phrase it. Whether it's net earnings, whether it's operating earnings, whether it's operating profit after tax, net profit after tax. Like, you've got to just understand these kind of little details. And so we're just going to try and kind of just air the closet on some of these acronyms, and in particular on software companies. So that's kind of both of our areas of focus. So why don't we just start at the top, mate? And I've got to hand it to you. You wrote an article on one of these terms, which we'll get to at the end, and it appeared first in Google when I was trying to find literature on it. So kudos to you. The first thing we might talk about is, we're just going down the list that we've put together. Can you just explain the very basics? So we're going to start at basics, and we're going to make it a little bit harder towards the end. What is revenue, and then what is ARPU?
So revenue is relatively simple. It's just how many dollars you have made in a given period from selling your software, right? It's not how many dollars you have received, but it's how many dollars basically you have booked towards the sale, or booked towards the use of your software. The use of your software is important because people tend to pay for software in advance. So we're not talking about that. But yeah, it's how much you can book this quarter or this year or this period for the software that you're typically, in this case, is not selling, but basically people are using, because most of the cloud software would be cloud-based. How do you think I go? Is that all right?
Yeah, I think that's good. And revenue, obviously, it goes across not just the software industry. We have that almost anywhere. What's one really important distinction to make here is, when we say revenue, we're not talking about cash flow. So those are two different things. So some people think that when you make revenue, you make cash, but there are many instances, particularly outside of software, like agriculture, for example, where companies earn revenue because they're required to under accounting standards. Say, for example, the increase in the value of olive trees or pine plantations, but it's not actual cash flow. It's just accounting revenue. So those are two different things. But for software, I'd say your definition is spot on. How about then ARPU? ARPU is sometimes what we call it. What is
this is a fascinating term that came from the world of telco, right? I mean, ARPU was big in the telco, which is telecom world. ARPU is just average revenue per user. This is relevant because, if you've got the average revenue per user going up, then that's good. It basically means you're selling more, or more is being purchased by your client base. It means you have more modules being sold, or, if it's a usage-based platform, then more people are using it, or they're using more of it. And that's great. Usually, higher ARPU would mean, indirectly relate to satisfaction. People are satisfied with what you're offering. They're getting value out of it. They're spending more with you. So that's what ARPU is.
Great definition. I like it. So we like to see ARPU going up because it means that the spend per user on average is going up. Great. Okay. So next one, we're flying through these, which is good, is gross margin. You and I talked about this, gross profit margin, gross margin, and we talked about this a little while ago. And this is typically when people talk about software, they say, oh, it's got high gross margins, and that's a good thing. So can you just explain what that means? This is like moving further down the income statement, right?
Yes. So the gross margin is interesting because gross margin basically would say, there's some cost for making the software, right? Now, that cost is there. There's cost for delivering the software as well, right? So if the software is running on the cloud, then you have cloud infrastructure bills that you're paying for, right? Those would also be for cost of goods. So the cost of goods is going to incorporate that. If you have people delivering customer success, like they're helping the customers understand how to use the software and how to deploy it, so basically acting as consultants, but provided by the company, they will also be part of the cost of goods sold. they'd be incorporated there most of the time. Sometimes they might actually be sitting lower down in the sales and marketing. So this is basically all the direct costs related to provisioning, enabling, and delivering the software, right? Now, the creation of the product or new ideas, that basically sits under R&D, right? It'll be R&D cost. And if people are, helping actually produce new logo wins for customers, and that would be sales and marketing, right? So, or advertising, it'll be sitting under sales and marketing. But yeah, the gross margin would be basically revenue minus costs of goods sold. And there's a little bit of flex in terms of what actually is cost of goods sold for software. As I said, you could move whether customer success should be, how much of it should be in cost of goods sold, how much could be sales and marketing, that is variable, how much of the R&D is the R&D, and how much is actually day-to-day running is also a little bit depends. I think there's enough room there that you can make these judgment calls. So. And then, of course, there's cost for running things on the cloud, which is very easy to understand. That's just the cost.
Yeah, and I think that's a really rounded definition. So basically, on the income statement, you have revenue, which is the one we just talked about, minus the cost of goods sold, gives you gross profit, gross margin in dollar terms. Sometimes we express it as a percentage, and we like to see high percentages because that means that there's only a little bit going to that cost of goods sold. The way I think of cost of goods sold and the way I explain it is kind of the unavoidable costs involved in selling. So if there's anything unavoidable, that's basically going to go in there, or at least it should. And then all the other stuff further down the income statement are expenses, and they can be separately kind of broken out for you. So things like R&D and sales and marketing, as you mentioned. Okay, so the reason we're doing these in a very deliberate order because they actually are kind of all building to an understanding of investing in software companies. The next one, which we can put in here, I guess, is churn. Just very basically, what does churn mean when we talk about that in software?
Yeah, and this is for our listeners or people who are viewing this. This list and order was put together by Owen. So he did the hard work of actually making it logically flow like this. Just I had no contribution to this. In fact, I just saw it. I'm coming up with the answers. I didn't even get to prep for this. I should have got some time. This is like quiz. He's like quizzing me here. It's great fun. So churn. Okay, churn is basically. Here's another thing I wrote about churn. So this stuff I actually did some analysis. Churn and lifetime value and ARR. These are three things I actually wrote an article as an advisor update just recently last week or not too long ago.
All right. Okay.
So I actually quite enjoyed doing this. So churn is just the percentage of customers leaving. Okay. Ideally, you want to describe churn in terms of 100 people. If you have 100 customers and one leaves, then it's 1% churn, right? Retention rate is just 1 minus the churn rate. And that's just churn, customers leaving.
Okay, so you've written this article for 7 Investing, which is actually a free article. It was the first one that appeared in Google. I'm just sharing my screen with you now. While we're here, so we've just discussed churn, which is basically the percentage of customers leaving. And the opposite of that would be retention. So if you have 1 of every 4 customers leave, that would be a churn of 25%, 1 divided by 4. And if you have the opposite of that would be 75% stay. So that'd be retention. Okay.
Yes.
How about this? Probably the one that we've spoken about a lot recently, which is very important, is dollar-based net retention, DBNR. This is kind of a bit of a step up from the other metrics that we just talked about, but can you, because it relates to churn, I think it's worthwhile explaining. So can you just kind of, as easily as you can, just explain this for us?
Yeah, I think now we are jumping a bit because one of the things that we could talk about is the relationship between churn and lifetime value, right?
Okay, let's talk about that then. Do you go in the order that makes sense for you and for listeners?
No, I go in the order that Owen told me to go on.
Okay.
So, and then we can come back to this. So lifetime value is very simple, right? Lifetime value is actually, you can calculate lifetime value as 1 over 1 minus retention, or 1 over churn rate. Okay, so the lower the churn, so if your churn rate is 1%, then your lifetime value is basically 1 divided by 0.01.
Yep.
Right, which gives you 100. Then lifetime value basically tells you the average time you expect your customers to stay with you. Now that 100 sounds way too large. Basically, when you've got churn that low, it almost means that customer is going to use your software for as long as your company is going to be around. It seems like that, but it's not quite true. But that's what the math says. The big thing about churn is that if your churn is 50%, then your lifetime value is like really small, right? And if your churn is really low, like 2% or something like that, then your lifetime value is really high, and a lifetime is really high for customers, and that's really good because the lower the churn, the more you can spend upfront to acquire those customers to have big fat free cash flow down in the future. But if your churn is high, then you really don't have the potential of doing that because you're spending a lot of money to acquire these people who are just leaking away, right? So it's like a leaky bucket phenomena, right?
So it's like that, that the duck that's swimming across the pond in front of you, and it's wiggling its legs really quickly, but it's only going a certain speed. If you have less churn, it means it's better because there's more customers staying. So it means you don't have to reacquire the guys and the gals the customers that you got last year. They're still with you. So the new customers that you're getting are just adding to that list rather than like a sieve kind of just losing them. Yeah. Okay.
Yeah. Yeah. So leaky, you don't want a leaky bucket. It basically talks to a couple of things. Leaky bucket basically means either your product market fit is not there, or your product is really crappy, or that you don't have your sales and marketing figured out. There's something wrong. It might be that you have a great product, but you're not selling it to the right people. That's again another reason why you have high churn. So just figuring that out is really, really important, and it helps with sort of planning for these long lifetimes, and then sort of enjoying the fruits of those long lifetimes. So the dollar-based net retention, this is the metric that's used quite often, right? Or you can just talk about, it's called just the net retention rate, right? And that's what the article talks about. So, and the interesting thing here is that a lot of companies stopped talking about churn because churn does not tell you on a dollar basis what happened. Whereas the dollar-based net retention basically takes the churn, but also talks about the dollar value of the churn. So if you lose a low value customer, that's okay. If you lose a high value customer, that has a problem. So this example that I had is just a simple fictitious example. At the start, let's say you have four customers, A, B, and C, and D. The first one is $1,000 a year in terms of value that you're going to get out of him for that year. The second also 1,000, the third also 1,000, and the fourth also 1,000. How simple is that? It never works out exactly like that, but it's just an example. In scenario 1, what happens is the customers A, B, and C continue spending exactly the same as they were spending at the beginning, right? Think of this as
$1,000 from those first 3. Yep.
Yes. And one of them churned away, right? Now, what is interesting about this one, though, is this metric, though, that it doesn't capture the fact that actually you had churn of a customer, and your total income at the end of this first period is actually less than that at the beginning, right? If you noted this example. So, because dollar-based net retention, by definition, is looking at those customers that you have left at the end of period 1, compare that with those customers that you had at the beginning of the period, and you're looking at the common customers and how much revenue are you generating from that base. So it's net of churn, it's net of upsell, and net of downsizing, right? Or net of contraction. So net of expansion, net of contraction, and churn. So in this case, your churn actually is 1/4, so 25%, your churn on a customer basis, but your dollar-based net retention is actually 100%. Because those 3 people that you had, those 3 people are common across, and they have maintained their sales with you in terms of 100% being 100%. So it basically tells you that those. Yes.
Sorry, go on.
No, so basically in this case, for scenario 1, it says that those customers that stay with you, they continue spending the same amount as they were spending last year.
I think the key there is the customers that stay with you, because some customers have left. So we're excluding those that have left. And that's so if you were to look at this, you'd be like, well, I'm only earning $3,000 now, where I was earning $4,000 last year from these customers. Even though my dollar-based net retention is 100% still, it's less. So you've got to,
Yes.
obviously the punchline is here, you've got to use more than one metric. Okay, so what about
Yes.
another scenario? So we've still got, let's say we've got those 4 customers paying $1,000 each at the beginning of the year. Let's do another scenario where at the end of the year, there's a different mix.
This is the scenario too, that exactly that you talk about on the on there, which is, customer A lands up now doubling their spend to 2,000. Customer B increases spend to 1,500, which is 50% more. Customer C, and that should have been seen as a typo there. Oh, I noticed that now. It should be 1,000, and then one of them has churned out. In which case, in this particular case, then in scenario 2, the total spend from those customers that remained has increased by 50%. Right.
So we've got dollar-based net retention of 150%. Even though we've lost one customer, the DBNR is 150% because those that remain on average are paying more.
Exactly. Across the 3. Yeah. So the DBNR is really useful for on a customer basis, on a retention basis, to think about how much more are you able to get from those people that remain with you. Right. And it's one of the metrics that a lot of companies talk about, that on a dollar basis, net of churn, net of expansion, net of contraction, how much am I getting out of my cohort that is staying with me? Right. Ideally, actually, I would like to see both, right. But I mean, you can make out whether, if there's high dollar-based net retention, but revenue is not growing, then you know that something is going on. Right. When you get high, basically you want to see the combination of high dollar-based net retention with revenue growth. And that basically tells you that everything is actually going well. One thing that I'll say, this is the interesting bit, is why I think people talk about DBNR, or basically net retention rate, is this. So think about a company, initially when a company is generating less revenue in total, everything is going to be driven by new logo wins. When new logo, basically new customer wins, right? But think about an early stage business that has DBNR at say 150%, right? It's generating 50% more from those customers that stayed with them, and it is winning new customers at a phenomenal pace. If it can maintain that 50% growth from existing customers, that is phenomenal, because eventually when the business becomes large enough in size, you would generate a lot more from your existing customers. Your existing customers become like this cow that you can continue milking for a long time. And that happens via a couple of different ways, right? Happens because your product expands, or you're able to charge more for your product, or a combination of those things, right? Or because people bought initially few modules and then expanded. They basically bought more of your software over time, right? So $1 billion business with a net retention rate of 120%, well, that's $200 million just coming from existing customers. That is pretty phenomenal, right? So yeah, and I think that's the key takeaway, and why I think that metric is important.
Yeah, we've talked about it a lot, just insofar as it being like a crucial metric to determine that kind of land and expand types software business model, where they might start with one module. Cloudflare might be a good example. You might get Cloudflare for hosting, but then you realize there's this whole other suite that comes with the Cloudflare platform, and then all of a sudden you're spending more because it's a better service, and you switch from your current providers for whatever it might be, for security or whatever. And then all of a sudden you're spending more and more and more. And so this is a really powerful one. The other one that gets thrown around a lot, at least here in Australia, and this is probably the fine one. Oh, we've probably got 2 here. Is this thing called ARR. If I spelled it out for people, I think they'd guess what it is. But what is ARR?
So ARR is just annual recurring revenue, right? So recurring revenue basically is, if you sign up to a subscription, like you have a Netflix subscription or an Amazon Prime, then you know that there's a monthly fee that you're paying, and as long as you're not canceling, that's what you're likely to pay, right? So you look at your customer base and say, well, I've got 100 customers and they're each on average paying this much. Then you take that and you multiply it, and that gives you your annual recurring revenue. It talks nothing about the churn or anything. It gives you at any point in time a snapshot of the revenue that is recurring, right? Of course, you could adapt this to say that, well, this is how much of it I'm likely to retain, and therefore that's the recurring part. But let's just think of it as existing customers that are, paying a subscription fee, you multiply that and you get it. So annual recurring revenue is just that, and ARR is not the same thing as revenue, because you might have picked up a customer, say, in the middle of the year, right? And they're likely to spend, say, $100,000 every year. So your annual recurring revenue is from that customer $100,000, but for that particular year, you might only report $50,000 because you've only used them for half the year. So typically revenue would trail annual recurring revenue. Annual recurring revenue is like a leading indicator. So if annual recurring revenue is growing quickly, and the churn rates are low, or there's expansion happening, then you would expect revenue at some point to get to that point of the ARR. It's going to trail. And therefore it can be a leading indicator, and it's kind of useful to get a sense of how quickly the subscription base is growing and how much are they spending.
I've got two questions that have come through here quickly for you. The first one came from Vinoth, who asks, can this metric, as in dollar-based net retention, can this be used to justify a higher price to sales ratio?
Yes, that's brilliant. I love that question. So the beauty is, actually this is an article. Unfortunately, this is actually behind the paywall. So if you can think of this way, I'll just try to work it out here for people. If you've got 50% more that you can generate from your existing base versus somebody who can generate 20% more, now think about that compounded over a large number of years. If you can, so as long as you're bringing in new people into the system and you're able to extract that extra from them over that time, this is pretty powerful. And you'd see that there's a huge divergence. So you would see that the total revenue growth that you can get just by the power of that retained customers growth is phenomenal. And it's indirectly, you can think about it this way: people love you so much that they're willing to spend so much more with you, right? So it's just a power of the platform as well that's being reflected. So yes, I would expect that companies with high DBNRs are appropriately valued as such, right? The only caveat I would say is that if you have a relatively small suite of products that you're offering and you're not a usage-based pricing model, then you could, if your product is that good that everybody buys everything upfront, then your DBNR is naturally going to be low. So you have to think about that as well. But yeah, for certain business, like Snowflake is a great example where the DBNR is like 150, 160%. Like, I mean, there's reason why that stock trades at the multiple it trades, because not many business, and of course it's got usage-based pricing, so it's not really a fixed, seat-based pricing model. So it basically says that people are just using more and more of this thing, and people love it, right? And that can really that can just give you phenomenal compounding. So yes, and my rule of thumb is I look for 120%. Like that's just, I like to look for 120%. I'll make allowances here and there, but 120% is really top notch in my view.
Okay, one more question, which is from Robin, who asks, would this metric of dollar-based net retention be easily available on the financial statement of software companies like Xero? I can answer a bit of that and then I'll throw it over. Vinoth says 168 is the current DBNR for Snowflake. So back to Robin's question on Xero. So Xero, if off the top of my head, reports monthly annualized recurring revenue. So what that means is it basically takes the last month's of recurring revenue and then multiplies that by 12. So, I guess an example, Xero is a very stable business in terms of its user base. So its churn's quite low. So it can do this and it's reasonable. But imagine if you had like an ice cream business that sold ice creams on subscription. If they took the recurring revenue figure in February in Australia, when it's really hot and they're selling a lot of ice creams, you might get a different figure for recurring revenue than if you did it in the middle of winter. So that's just an example of how recurring revenue figures can kind of go either way. But DBNR itself, so that was a kind of an example in recurring revenue, but DBNR itself is not as popular in Australia as it is in the US. At least maybe they just don't want to show it as much.
Yeah, so I was going to comment on this. So when I looked at, so one of the things is that here's something to realize, right? So even a DBNR for a business like Xero is actually not going to be very high because it doesn't have significant upsell potential, right? So actually for a business like Xero, really the metric that should matter is just the churn rate, which would be, which would reflect the churn rate you would see of SMBs, right? And as long as it's just that, that's good. Or lower than that, that's great, right? So we have to compensate. So this DBNR metric is really an enterprise SaaS model metric. And by that I mean companies that sell to other big businesses. It's relevant for that. If you sell to smaller businesses, then a DBNR is a difficult metric to show. And also, if you're a small software company, then I mean, how do you really show it? So it's not really shown in Australia, largely because I think the companies that are here are more niche. They have a smaller number of modules. I believe Elmo has at times reported, I think, net retention rate.
Yeah, I think we talked about that. Yeah.
And I think they do report net retention rate. Again, you have to contextualize it. That, you know, if you're serving that type of customer base, like small, small to medium scale customers, then it's going to be different from that you serve enterprise customer bases. So I haven't seen that many, but Elmo is one definitely that reports net retention rates.
Great. And the final one on our kind of list of metrics is customer acquisition cost. So CAC, CAC is often how it's written. Can you explain what this is? Maybe how to calculate CAC, and then why?
Yeah, so CAC is just the cost. You know, this is one of those metrics that I'm actually not a big fan of. So, because I don't really pay that much attention to CAC, because a lot of times companies actually don't report CAC directly. But so CAC is basically just the cost that it takes to acquire an average customer, which is, you know, net of what you're spending on sales and marketing and things like that to get this. You know, you can compute it, and then you can of course use. I guess CAC became really famous in the startup land because people wanted the CAC to be look at CAC and then look at LTV. So LTV is the lifetime value, look at CAC, and you want that multiple to be like, 4x or more. That sort of became like, the holy grail in the startup land. And if you were like 8x, like lifetime value is 8 times CAC, then, well, that's great, right? It just basically told you how much more you could spend to get customers. But so I think CAC is useful from that point of view, but I think, yeah, I don't use CAC that often. That's just my thing.
Yeah, so customer acquisition cost is basically something that you can get if management break out sales and marketing on the income statement. You can take that and you can divide it by the number of users in the period. If you don't know necessarily, like if they report net users, so if a management team just reports number of net users or the user number is net of churn, then you don't always know exactly how many they acquired versus how many they lost. So you can't get an accurate reading on what is the customer acquisition cost. But if you knew how many customers were added during the period, just added, not lost, so just added, you could take the sales and marketing, divide that by the number of users added to get you basically a cost of acquisition, the cost of adding those users. And this can be I find this can be useful when you're trying to work out if a company is in that kind of rapid adoption phase where it is able to spend the same amount, more or less, but the actual per unit cost is coming way down. And that's kind of a sign that a business might be hitting an inflection point, at least in terms of acquisition of customers. So that's an interesting one. So that kind of rounds out our software metrics. And you said there that you basically.
Can I quickly ask a question? How would you then adjust? I guess you wouldn't in that case, just because sales and marketing would also include like expansion revenue, right? So sales and marketing is also contributing towards expansion revenue. And if that's not broken down, then it's really hard to know. You kind of have to guess estimate what that well, I guess if you have the DBNR number, then you know how much the expansion revenue is, you take that out. And then you'd have to know how much was the revenue that churned out. So, I mean, you have to make some guesses there to get to true CAC. But you can get to a first order CAC via what you said.
Yeah, absolutely. You can just get, and I think the important point is kind of directionally right here. If it's, $10 or $12 for a customer, I don't know what the product is that they're selling, but if it's a $10 customer acquisition cost, and it's now all of a sudden looks like it's heading to $5, well, then that could be something that's really interesting. You may not know perfectly, like customers don't always break out what's customer success versus marketing. Sometimes they do. I think Afterpay for a long time broke out just flat out marketing. So you could potentially do that. Some companies provide it for you, but you just want to check their assumptions. As always, you want to check their assumptions. But in summary here, we've got dollar-based net retention. We've got churn rates are important. We've got total revenue, annualized recurring revenue. We've got a lot of metrics here, but I guess the key is if you have to go back and listen to this again, we're looking for customers that are spending more, companies that have customers that are spending more, so dollar-based net retention. We're looking for that revenue to be increasing. We're looking for low churn or high retention, depending on which way you want to think about it, and a wide gross margin. Those are just some of the things you want to look for, because those are signs that a business can justify a higher valuation.